I'm going to talk a little bit about the outlook for the global economy. And I'm going to apologize to begin with, because I'm going to start with an economics lesson. And I know some of you will thinking, if I'd known this, I'd have skipped the first session. So I will apologize, but I'll explain in a moment why I'm giving the economics lessons. And it's because of where economies are in the cycle, because it's where they are in the cycle that is basically can explain what will happen to GDP growth, economic growth, over the next year or two. Now, this is a sort of stylized example of how economies work, with time along the bottom, time measured in years rather than months or quarters, and up the side, the level of real GDP. The first line to look at is the blue line, which is the productive capacity of any economy in the world, whatever economy it is, that hopefully grows slowly over time. And that, as you look top right, is a function of, and only a function of, labor inputs, capital inputs, and the interaction between the two. So labor inputs being the number of people, the skills those people have, the hours they work. Capital being IT, factories, buildings, whatever it might be, and how good it is, and then efficiencies and interactions between the two. And it's only changes in any of those things that lead to sustainable increases in GDP. So if you take an example of a hairdressing business, that shall we say a hairdressing business employs 20 people in a particular day, employs 2 people, does 20 haircuts. Doesn't take quite that long with mine, but others are a little more complex. So they do 20 haircuts, and then someone says, I wonder what that business's output will be in 20 years' time. And they say, well, what does the business look like? He says, well, it still employs 2 people. They've got the same scissors, the same other stuff that I'm not going to go into what other stuff is because I don't know, the same other stuff, and they work in the same way. Then the number of haircuts they will be giving will be still 20. Their GDP growth will have been 0. And what applies to a hairdressing business applies to an economy as a whole. So it's only changes in labor, the amount of people, their skills, and the amount of capital you have that lead over long periods of time to sustainable increases in employment. And what Liz Truss was trying to do, by the way, was raise the slope of that blue line, which is a very laudable goal and exactly what governments should be doing. Execution, I won't go into, well, not very, let's put it, well, appalling. So that's the blue line. The red line is what GDP actually is, and that's what gets measured and appears in the press the whole time. And that moves up and down over time, depending on whether we're optimistic or pessimistic. Businesses are investing, they're not investing, and so on. But it must always be near the blue line. Now, again, I know for people who did a little bit of economics, GDP is, you add up, C plus I plus G plus X minus M. Consumption plus investment plus government spending, plus government spending plus exports minus imports is GDP. And that moves up and down around the blue line. Now, if you are below the blue line, so where China is there, then you will be operating below full capacity. That will mean that you will have high unemployment. You will have people not working the hours they want to work, and you will have generally falling wage growth and inflation. And from an HR perspective, it means that if you stick out one job role, you'll get 50 applications. And I remember a decade ago or so when we had high unemployment here in the UK, I was speaking to someone from HR, and she said to me, oh, I've got, I've one open position, I've had 50 CVs, and they're all quite similar. What do I do? And I said, well, I'm no expert on this, but my advice would be to take the first half of the applications and put them straight in the bin without reading them, because you don't want to be hiring someone who's unlucky. And so when you're below the blue line, you are operating below full capacity. When you're above the blue line, you're operating above full capacity. And so you have very low unemployment. You have businesses struggling to fill open positions. You have upward pressure on wages and inflation generally. And I should have said, before I got into my little joke, that if you're below the blue line in China's case, Monetary policy will be loosened as central banks will do whatever they can to boost economic activity by lowering interest rates. If you're operating above full capacity, then central bankers will do whatever it takes to slow economic activity by raising interest rates. If you look at the moment, and why I'm talking about this now, is that both the US, the UK, and China are at extremes. Now, some of those extremes have improved a little bit. The UK, you'll all be aware of this. The US has a less tight labour market than it did, but it's still tight. But if you're a long way from the blue line, growth has to be either strong, in the case of China, or weak, in the case of the US or the UK. There is no scenario under which UK-US growth is going to be good, strong, over the next 12 months or a year. Because even if lots of good things happen, even if the war in Ukraine ends and US-China relations dramatically improve, Harry and Meghan and Prince Charles and William become friends again, even if lots of wonderful things happen that all else equal would boost the economy, the central bankers would be tightening policy to loosen it. So just one final example, because I sometimes think examples help, is if you have an auto company, and if them operating at sort of normal full whack is 1,000 cars a month or something, and then for some reason they push that up to 1,100 or 1,200 in a particular period, with everybody working over the weekend, flat out, no breaks, etc., and someone says, is the output next month, next year, going to be higher or lower than the 1,200, the 1,100? The answer is lower. It's got nothing to do with anything on the demand side, nothing to do with whether people are buying cars, nothing to do with interest rates, simply because they're operating below full capacity. So, the US and the UK are going to have weak growth. I'll speculate on how weak going forward. China is going to have strong growth because the level of activity is very low. Japan and the Eurozone are somewhere in between, and their GDP is going to be determined by the normal sort of things that people like me talk about. Are people confident? Aren't they confident? Are businesses investing? Aren't they investing? What governments are doing, and so on. I'm not going to go into detail on those economies, but Japan we think will do well, and the Eurozone, which isn't doing very well at the moment, slowly getting a little bit better. Now, this red line being somewhere above the blue line, which really applies to the UK and the US, it can follow one of two sort of paths. The yellow or green line, which we call a soft landing, where activity is flat or small positive, but it doesn't go negative, and that slowly gets you back to the blue line, or a period of negative growth that lasts a while, that takes you well below the blue line. That implies a big jump in unemployment and everything that goes with that, and major stress on companies. And then you would get a big monetary policy loosening, and economic activity would go through a strong period. It is important to note that at the end of the day, you finish up roughly in the same place. And so that if you think about the own businesses you work in, whether or not we have a hard landing or a soft landing, where your business is probably going to be in, shall we say, 2028, is pretty ill affected or unaffected in terms of demand for your products and services on whether the next year or two is going to be good. Now, our best guess, and I use the word guess intentionally, because there are so many factors that are out of the control of unforecastable in terms of the economy. Our best guess is that we're going to have a soft landing. So positive growth or zero growth well into next year in the US and the UK. Households still have some cash, a reasonable balance sheet, they've got jobs. Corporate sector remain very profitable, and therefore we think some major retrenchment is unlikely. So next up is inflation. Now, as you'll all be aware, inflation rose very, very sharply last year and has started to come down, and I'll talk about the outlook from here. But it's worth thinking about, why did inflation go up in the first place? And it went up because of the things in those blue boxes there, all of which happened at exactly the same point. If they'd happened at different times and independent of each other, then maybe we might have seen a modest short rise in inflation, which would unwound itself reasonably quickly. But they all happened at the same time, which changed the mindset of businesses. It changed the mindset of us employees in terms of what we want for wages and so on. But Benoit, by the way, in terms of retaining staff, more cash generally helps. But we needn't go there. That's for our HR people. But all of these things happened at exactly the same time and pushed inflation a lot higher. So first up, and in advance of the Ukraine invasion, commodity prices were firm and obviously skyrocketed when that happened. We then had the reopening of the economy post-COVID, post-Omicron, and that led to a jump in hotel prices, a jump in airfares and things like that. We also had all the supply chain problems, which pushed up the price of used cars, new cars, but used cars went up 60% or more, up to 100% in some places because of the chip shortages. At the bottom, and more of a US phenomenon than a UK phenomenon, we saw a big rise in rental prices because of zero interest rates. And we also saw a rise in wage growth for reasons with this audience I needn't go into, but the really tight labour market, basically. Where we are at the moment is that with the exception of the labour market, all the others have turned. Commodities have certainly stopped going up, and if anything, have come down. You'll be aware that a litre of unleaded hit £2 not so long ago, a year and a bit ago, went below a bit 150, now a bit above 150, but still down from the £2 we were at, so negative petrol price inflation. Home electricity and gas prices have come down 20% since July. So we're starting to see not just those things not going up, but actually coming down. The reopening of the economy only can happen the once following COVID, and so while hotel and airfares are really expensive at the moment, they've to some extent stopped going up, and we've seen big falls in the price of things like used cars. I'm not going to talk about rental growth, it's a bit different here in the UK from the US. But the one thing that hasn't really come down to any great extent is wage growth. And that's because wage growth tends to lag the economic cycle quite significantly. As you'll know, in most cases, people generally only get pay rises once a year, and it often reflects what happened the year before rather than a particularly strong forward-looking indicator. And while headline inflation has come down, unemployment remains, again, as you'll know, I'm speaking to an audience who knows a lot more about this than me, so it does make me nervous. But you'll know that labour markets remain still very tight, although I would say less tight than they were. But it's likely to take quite a long time for wage growth to return to normal levels. And for inflation, wage growth really matters because wage growth makes up about 2/3 of total costs. Again, thinking about Mercer and sort of numbers that Benoit has to deal with, if I say to Benoit food prices are going to go up, does that affect Mercer profitability? The answer is no. If energy prices go up, does that affect Mercer's profitability? Not really. It's very small relative to total corporate costs. It's the labour bit for many businesses that is by far the most important cost for businesses. And if wages go up and companies want to protect their margin, they're likely to seek to charge their clients that bit more, and that is inflation. So when we look forward, we're expecting that all these sort of things that have turned negative to push headline inflation sharply lower over the course of this year, and for headline inflation rates to be much more normal going forward. They're already much more normal in some places. UK is a bit slow to the game in many. I think politically you'll be aware of that. But the core level inflation, which is the one that central bankers worry about, is likely to be a little slow to normalise because it will take a while for the labour markets to get back to normal. Now, this is what my colleague Julius put together. We're thinking of trying to get it patented or trademarked. Tell me if you like it. We call it the wheel of inflation. And you start bottom left, and in bottom left if you're a situation of high unemployment, people like me say, any chance of a pay rise? If I don't get a pay rise, I'm off. To which Benoit replies, well, we'd be sorry to lose you. You've done a great job, and we'd like you to wish you the best going forward. But there are lots of people who could do your job, and when you actually go out into the marketplace, you might find there aren't many jobs out there. And I said, well, when I said I was going to go, I didn't really mean I was going to go. It was just sort of, it was an opening chat. But when you have low unemployment, I say, not so fast, Benoit, not so fast. You know that if you have to, I don't really have this conversation, but implicitly employee says, you know if you have to replace me that you might struggle to find someone, you have to pay costs in getting someone, they may not be quite so good, all sorts of things. And that all pushes upward pressure on wages, bottom left. Because wages are going up, top left, companies seek to charge their clients more to protect their margins. That pushes up inflation because they put up their prices. That puts pressure on consumers who then demand higher wages to pay for those higher prices. And round you go, and the only way you can break it is to slow economic activity, to raise the unemployment rate, to slow wage growth. So central bankers are actively planning to raise unemployment. It's not a fallout. It's not that this is an unfavorable byproduct of their policy. It is their policy. Now, I'm not going to show you a massive data, and I'm certainly not going to take you through this page here. But basically, green is growth, red is not growth. Goes back a few years on the left, countries down the side. And you can see that GDP growth, this is the service sector, the business part, the biggest part, has actually been okay. Manufacturing's been doing notably worse, but service sector has remained green throughout. So we've seen resilient growth. With the exception of India there, which is the one that's dark green, we're seeing sort of moderate growth, not strong growth, but not recession. There are some clouds on the horizon, both before the collapse of Silicon Valley Bank and after the collapse of Silicon Valley Bank. We've seen a tightening in lending standards. So this is separate from prices. The price you pay for your mortgage and other borrowings moves up and down in line with interest rates, roughly. But then businesses, or banks, have their sort of tendency whether they're going to lend or not. So when, this is an actual live example in 2006, before the financial crisis. I worked at Goldman Sachs, and I applied for an Amex. They asked no questions whatsoever about anything. Does anyone work for Amex here? They asked no questions at all about anything, gave me this credit card. I called them up and I said, what's the credit limit? They said 40,000. I said, 40,000? They said, do you want more? And I said, no, it's just that I'll never use 40,000. Only a crook would use 40,000. Can we please cut it to 10? Which they did. My next door neighbour at home, who's got pots of cash and of an age where he doesn't have a mortgage, or at least I don't think he does. He's got the house next door to me in a flat in London, so I think he's fairly well off. He told me in 2009 he'd got himself an Amex with a credit limit of 2,000. He had asked for more, and they said, talk to us in a year. So this is not a question of the interest rate being charged. This is the intentions of borrowing and how much banks want to lend. And it's pretty closely correlated historically with actual credit growth and actual GDP, and you can see a notable tightening. And so that, again, makes us a bit cautious about the outlook. I think it's not as alarming as that looks. That measures breadth, not depth. So that measures that quite a lot of banks are saying we are tightening lending standards. It doesn't say how much they're tightening lending standards, and I think the answer is not a lot. I won't get into China, I won't get into these slides, which I'll apologize for. I shouldn't have put them up, they're way too complex. But basically, China's property market is imploding. Here in the UK, property matters. It matters more in China, and it is exceptionally weak at the moment. But the overall economy is doing much less poorly, and as I said earlier, the Chinese authorities will do whatever it takes to stimulate the economy. And so we would expect growth to pick up, and early data suggests it is. These are unemployment rates in the US and the UK. Just the US on the left-hand side, Eurozone on the right. both of which are at multi-decade lows. Now, we have seen some loosening. We have seen the number of open positions fall. We have seen, as I'll show in a second, signs of wage growth slowing. Now, there are lots of different ways you can measure wage growth. Top left is the three main ones there. The employment cost index is the broadest one of them. It's the purple line. Perhaps don't try to look into this until you get sent them. But the employment cost index was at about 5.5, 6, is now at about 4.5. Now, that's still a bit elevated, but it's not massively elevated. How an economist looks at wage growth is they would say, well, if you want to have 2% inflation and you have 1.5% productivity growth, then you need to have wage growth at 3.5% in order to keep profits reasonably stable. If you have higher wage growth than that, then businesses will have to charge their clients more in order to protect their margins. And so that if you have 3.5% wage growth, you have 2% inflation, 4.5 wage growth, 3% inflation, 5.5, so you just sort of add it on, unless in aggregate at a whole economy level, you can do great things with productivity, which I'll talk about in a second. So US wage growth has slowed from 5.5 to 4.5. We do think it'll fall back towards 3.5 through next year. Things like minimum wages won't be going up to the same extent as they did this year, with much lower headline inflation. Eurozone showing a similar picture. The UK wage growth numbers are truly awful. So wage growth in the UK, as reported, is 8% year on year. And rather than sort of, moving down as the other countries have done, actually the most recent data suggests it's strengthening again. Now, you can read that as obviously being bad news, except for those getting punchy wage gains. But it's also possibly rubbish. Most data, it's important to be wary of most data. So the example I sometimes give, I often speak to our finance director about sort of economic type matters, and if sort of head of MMC, Mercer's parent company, says to the finance director, how are the numbers doing? Looking good, says finance director. How is the business looking? Benoit, looking good, says Benoit. Benoit's equivalent at our sister companies, looking good. And then the numbers come out showing that they're not, then something's wrong. They must all be consistent with each other. And in reality, other measures of wage growth, other than the official ones, suggest wage growth has started to slow in the UK. And I'd point to the Bank of England's agents report, which came out on the day they didn't raise interest rates. It's on their website. They're talking about some interesting things in relation to UK wage growth. So growing at 6%, they say, rather than this 8%, and slowing from here, says all of their business contacts. So we think this is going to slow, so that's good news for inflation, good news for interest rates being on hold, but it'll take a while. Now, this is the interest rate one, and I know whenever I talk about interest rates, people's minds always turn to what's going to happen to my mortgage. Sometimes when I give these sorts of presentations, someone afterwards says, Rupert, I thought that was really interesting. I go, oh, thanks very much. And they go, yes, oh, thanks very much. And he says, now my mortgage is coming up for reset. Should I reset or not? To which I answer, I don't really know, because it's quite difficult to tell. But what this chart shows on the sort of the purpley line is the level of interest rates that markets are betting on at any point in time. So and then the green bars is what they're expected to do at particular meetings going forward. And the date goes out to 2026 or so. And so you can see that the Federal Reserve is assumed now to be roughly on hold, small chance of another hike, but on hold just below 5.5%, where they're expected to stay there for about a year or so, or 9 months, before cutting rates quite aggressively, perhaps, in the middle of next year. We're not expecting any further hike, but we're not expecting any near-term cut. But we don't think the broad brush of those numbers are particularly off the mark. In the case of the UK, which obviously is very relevant to all of us here, is the Bank of England is currently at 5.25, This chart was done before the most recent meeting, hasn't been updated. Sorry for that. We have to go through compliance and whatever. As you know, the Bank of England did not raise interest rates, kept it at 5.25. We think that's job done for the Bank of England. It was a 5-4 vote. Only 4 voted for a hike, 5 voted for unchange. 1 of the 4 is retired, so really it's only 5-3. And so we think the Bank of England is on hold. But we don't think the Bank of England is going to be cutting really at any point through next year, because it'll take a while for the labour market, for wage growth to go back to normal. Because if a hairdressing business is having to pay its staff 6% more, then it has to charge its clients 5% more. They've got no other real way of survival. And about a year ago, I was telling roughly the same story, because this sort of story hasn't changed. And then I went to have my hair cut, and up on the wall there was a sign saying it is with great regret that we've had to raise our prices for our haircuts because we're having to increase our staff pay. And I thought, that's brilliant. That's really good. I almost gave her a hug. And I want to take a picture, stick it in presentations, because that's the reality of it. And again, what applies to a hairdressing business applies to the economy as a whole. So UK interest rates on hold, probably for the whole of next year, before being slowly cut as we move into the year after. So in summary, we think that developed world growth, certainly in the UK and the US, will be poor, but not heavily negative or negative, over the next 12 to 18 months. Japan better. China's strong, because it's done really badly recently, with a key focus on being unwinding overheating in labour markets. Inflation to fall back towards targets at a headline level more or less everywhere, including the UK, but core levels of inflation, so that's stripping out volatile things like food and energy, to take a bit longer to get back to normal. And that keeps central banks on hold, even if we are pretty close to the peak, more or less everywhere. So no significant rate cuts we see in 2024, but possibly quite a lot of action in 2025. The one thing that isn't on here is AI, and I know we've got a chat on AI later. Now, and I'm not going to make a comment in relation to the HR side of things, but on the economic side of things, AI is hugely exciting, and very few things. If we go back to my old friend, the blue line, I love the blue line, really love it. Very few things change the level of the blue line. Liz Truss tried, failed. Brexit lowered it, by the way, but very few things actually change the level of the blue line. AI might materially change the level of the blue line over the next 10, 15 years, because it has the potential to allow businesses to replace labour with AI. Now, again, lots of businesses will be doing their own thing internally within Mercer. We have our own AI tool, but in one notice we're recruiting someone. All of this is moving very fast. Nobody really knows whether it starts to impact economic activity in 24, 25, 23. Where I am where my son is at school, one of the dads runs a dental business. He told me that he used to, until about 3 months ago, get somebody to write a sort of a dental update, which he would use online as a social media campaign, a few thousand quid every month or quarter. Now he gets it for free on ChatGPT. That's great for his business. And for reasons I perhaps won't go into today, it doesn't lead to high unemployment. Productivity, economic development is all about doing the same with less or more with the same. And AI could be hugely beneficial for the global economy, thus for global profits, equity prices, and of course, if that all does well, then governments have a lot more cash that they can spend on whatever they want to spend it on.